The work that we've done looking at pension fund returns and optimizing a portfolio suggests to us that most pension funds would benefit from having gold in their portfolio, somewhere between perhaps 5 and 10% of the weighting of their overall portfolio. Gold has been a source of returns over the long term, not just during periods of inflation or financial crisis. It also brings great diversification benefits as well. So we've modeled a typical US pension fund with all the weightings that it has based on Willis Towers Watson. We re-optimized that portfolio with gold, found it had the ideal weighting came out at 4.2%. And then we looked at how the returns would have been with gold and without gold over the last 10 years. You can see that by adding gold to the portfolio, you made a marginal increase in returns, but a substantial reduction in volatility and in drawdowns. So the risk-adjusted return of this portfolio was obviously much better. And we found as well is that within a range of gold allocations to this portfolio, from between 2% and 10%, the more gold you added, the better the risk-adjusted returns of that portfolio. Part of it was the return itself. So over the last 10 years, gold has delivered about a 4% return per annum. So less than equities, but more than bonds and more than cash. But specifically, it's the diversification benefits. Gold is generally uncorrelated to most other assets. And if you look at equities, for example, over the long term, there's not much correlation at all. But if you break down the performance of the S&P 500 over the last 10 years and look at the correlation under different circumstances, you get a different picture. So when the S&P was rising sharply, up 2 standard deviations within a week, gold was positively correlated to equities, which is what you want. But if you look at periods when the S&P 500 fell sharply, so again, down 2 standard deviations over a week, the correlation with gold flipped over, so negatively correlated. Again, what you want, negatively correlated to a rapidly falling asset. So this flip over in correlation to equities is very rare. We actually haven't found a major asset class that replicates this. And it gives tremendous benefits to the portfolio. So returns have helped a bit over the last 10 years, as I say, not as much as in previous periods, but the diversification benefits make a very important difference to the performance of the overall portfolio. We do know some pension funds that have physical gold and have it stored in safe vaults. That's probably for more experienced gold investors who have gone down the process of getting used to the idea of gold and having it in a portfolio and then focusing on the most cost-efficient way of doing it, because certainly for large exposures, that's the best way. There are other ways, of course, and the most common way would probably be through an exchange-traded fund. Exchange-traded funds are available in most jurisdictions with annual fees of somewhere between 50 and maybe 40 basis points per annum, and that's quite cost-effective. It's a very accessible way, trades on stock markets, so pension funds can access that very simply. It's only, as I say, I think when you have large holdings and you have got used to the idea of having gold in a portfolio, that pension fund investors can think about switching over to allocated gold, which probably carries a cost of more like 5 basis points per annum.